The US budget deficit just surged to $129.4 billion in December, a whopping 50% increase year on year. Only $429 billion was collected in tax income, while US government spending was at $559 billion, another step on the path of excessive spending that they are going down, which is quickly turning into fiscal collapse. And what's even more alarming is that December is typically a kind month for the fiscal budget, with December deficits typically being in the $10 to $20 billion range historically. This $429 billion in tax receipts was down 5.6% from December of 2022 and down a massive 11.8% from December of 2021, while on a last 12-month basis down 7.2% year on year. This is now the 9th consecutive year-on-year decline in last 12-month tax receipts, something that has historically only happened when the US was in a recession. Meanwhile, despite declining tax receipts, the $550 billion that the US government spent was 3.5% higher than last year. Net interest payments came to $68 billion, a significant 12.4% share of this $559 billion in total spend, which is only going to keep growing as the budget deficit grows and the US government racks up more debt. And if you look at how much federal government expenditure on interest payments has increased in recent years, you can see that this growth has been exponential. Federal debt as a percentage of gross domestic product is already at close to the all-time highs that we saw in the 1940s, now at just under 100%. And with the current trajectory that we are on, economists do predict that this debt-to-GDP ratio is only going to keep accelerating in the coming decades to new all-time highs and could even push 200% eventually. And when you look at the size of the current deficit relative to GDP as well, and how this stacks up relative to historic deficits, we can see just how severe this problem is becoming. This latest deficit is a whopping 5.5% of GDP, larger than the deficit that the US ran during every recession in the last 100 years, except for the global financial crisis and also during 2020 when the economy completely shut down. If we are not yet in a recession and the economy is still growing, but the government is already spending at a pace that is usually only seen during a recession, then what is going to happen when we do finally enter into a recession? This could tip us into the global financial crisis territory of running at a budget deficit of close to 10% of GDP, which is a really scary place to be in if the economy does indeed head south from this point. Based on the current trend, the Congressional Budget Office does expect the budget deficit to be at 5% in 2027, growing every year to a whopping 10% of GDP in the year 2053 due to a much faster growth in spending compared to revenues. And being on a continuous budget deficit means that the government will need to raise taxes and print more money in order to keep operating, both of which would be detrimental to economic growth and prosperity in the US. Now, new money being printed and pumped into the system will lead to a deterioration of the US dollar's purchasing power, and combined with higher taxes will lead to the real disposable income for US citizens being destroyed. More dollars from workers' paychecks will be taken as tax, and the money that they are left with will be worth less thanks to all the new money that has been pumped into the system to sustain this large government budget deficit. The CBO expects that this will in turn result in extremely poor growth across the US, with real GDP rising much slower throughout the next 30-year period compared to the last 30 years on average. And with the budget deficit not likely to reverse back to a surplus anytime soon, mass money printing is all but inevitable in the future, which could lead to long-term stagflation. And based on the data from the end of 2023, inflation is already starting to show signs of acceleration, rising to 3.4% from 3.1% the month prior, exceeding expectations. Now, much of the surprise in core goods came from price increases for used cars and apparel, despite year-end promotional activity. And meanwhile, service prices held firm, notably within costs for housing and car insurance. The concern that must be growing in the Fed's mind at this point is that we are now getting less deflation and disinflation from goods and energy prices, and we still have yet to see a measurable reduction in inflation in housing or most services components, said the chief US economist at BMO Capital Markets. We're approaching 2 years now since the Fed started hiking rates at the fastest pace that we've seen in history, but inflation is still far from being defeated. This puts the Fed in a tough spot, as they will find it hard to start cutting rates aggressively when inflation is starting to climb higher, reversing the downwards trend that it had been on. Therefore, it is starting to look like we may not be getting the rate cuts in 2024 that the market was expecting a few months ago. If the Fed does, however, go ahead and start cutting interest rates aggressively, then we could be on a eerily similar path to the 1970s. And during this time, we saw inflation make new highs after excessive quantitative easing from the Fed, followed by steep interest rate hikes to fight off inflation. Once inflation came back down though, the Fed started to drastically cut interest rates as they thought that they had beaten inflation. However, shortly after this, it began to surge again to reach an even higher peak. Today, behaviour from the Fed as well as monetary policy are very similar to the 1970s, and the CPI data we are seeing is mirroring that of the 1970s very closely, meaning that we could have a big shock soon if it continues on this trend. And when we look at forward-looking indicators, there is even more evidence to suggest that inflation is set to push upwards, and the consequences of rate cuts now could be catastrophic. The Global Supply Chain Pressure Index, for example, leads CPI by approximately 6 months, meaning that whichever direction we see this index move in will shortly be followed by the inflation data. And this index has surged upwards in recent months due to the recent supply chain pressure, and when we map CPI on top of it, we can see that there is a very close lagging correlation between the two, pointing towards more upwards movement in CPI soon. The problem is though that if rates remain higher for longer, this is going to prop up bond yields, keeping them quite high, forcing the US government to pay a higher interest on their new debt, which we know they are taking on a lot of right now to keep operating. We're in a situation where the government doesn't have enough money to operate properly without having to borrow money, and part of the reason why they don't have enough money every year to function properly is because a significant chunk of their budget is spent on interest payments for past debt. But to solve this problem of being in a budget deficit, they are being forced to borrow more money and take on even more debt, which is only going to cause their annual interest payments to rise next year. This is why, really, the Fed may actually have their hands tied behind their back and may need to cut rates regardless in order to relieve some pressure on the US government's debt crisis, which is quickly becoming quite unmanageable. Of course, as we've discussed though, if they are to do this, then they may actually be helping to trigger a second wave of inflation in the future and all the problems that will come with this. Ray Dalio has already warned that the US is nearing an inflection point in which the US debt problem could quickly spiral out of control, especially with there being not enough demand from investors to match the supply of new debt. Ray does emphasise the fact that not only Wall Street banks, but also central banks across the world have suffered heavy losses in US government bonds already, and the appetite for this government debt is falling off quite significantly. We have already seen US bond auctions at the back end of 2023 fail to sell out, receiving far less demand from buyers than anticipated. And no matter what happens with interest rates, if there are simply no more buyers left in the market to take on new US debt, then the interest payments on this debt will skyrocket and could lead to massive problems therefore. Of course, we are definitely not at this stage just yet, but Ray Dalio does certainly believe it is something that the government needs to consider as a risk. Now, all of this will get a lot worse if and when we enter a recession, and in fact the US consumer could be the area to trigger this happening, as the consumer is looking very vulnerable right now. I covered this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.